our daily show where we get together, we talk about stocks, options, futures, anything in economics, in the news that's grabbing our attention that we think is going to impact financial markets and help you guys run your daily routines out there. Welcome, welcome, welcome. As always, if you're a veteran of our community, hashtag Team Tackle right in the chat. Always appreciate seeing that hashtag come in there. That's the one that we like to promote and kind of represents our tribe, our team, our community here at Tackle Trading. We got a full panel of coaches here today, by the way. We've got Mark, Matt, and myself, as always, Cody on the back end. But we welcome back Coach Noah Davidson from vacation. Noah, how are you doing, sir?
I'm awesome, Tim. It's really good and difficult at the same time to come back from being completely off the grid. Not even having so much a cell signal. So it's I'm trying to catch up with everything.
And so no Wi-Fi. Did you bring a computer?
Nope.
No computer, no Wi-Fi.
No computer,
so
no Wi-Fi.
What do you do with your trades? Do you just exit them before you go on vacation? You obviously keep your long-term investments. That's not going to change anything.
You know, I everything had either a closed-end risk graph or a stop loss on it. And I also put on a little portfolio insurance.
Well, that is very, very smart. Obviously,
which just so you guys know, I also should have, but I didn't opt for the jet ski insurance. I didn't get the extra supplemental insurance, and that one's going to cost me.
You crashed the jet ski on
not me personally.
But you are the responsible adult.
I am the responsible
name
adult
on the rental contract. I got you.
Yes.
I got you. I got you. Well, it's good to have you back, sir, as always. And everybody give Noah a big warm welcome back. Great to have him here. If you're brand new to our channel, by the way, we do this show each and every day. Click subscribe, click the bell. Come back and join us as we go live here at 12:30 Eastern Standard Time. Today's show, we got a Dow shakeup. I think that's probably the most noteworthy news of the day. We're going to give you our take, our analysis on it. Salesforce in, Amgen in, Honeywell in, ExxonMobil out. I mean, this is a Dow component that's been in there since 1928. We're going to talk about that, as well as Pfizer and Raytheon also out of the Dow. They're going to be moving that shakeup. I think that goes live here pretty soon. Stimulus conversations continue to be ongoing. Not really a lot of progress there. There was some conversation about the phase one trade deal, though, between Mnuchin, Lighthizer, and Prime Minister He, I believe. Other than that, some economic data, a couple of earnings roundups, and notable news out of Apple and ByteDance. Matty, how you doing today, sir?
I'm doing absolutely fantastic. It's good to have Noah back from vacation. And Noah, there's no catch up. There's too much that happens on a daily basis. Just delete it. Nobody's going to remember, and just move forward.
Oh yeah, absolutely. I didn't read any past headlines. I just started reading current headlines.
Oh, it's impossible.
Yeah, I just looked at the charts.
It's impossible.
Yeah.
Like if you're like, it's such a therapeutic thing too, though, to get away from the phone and just to like enjoy life.
Oh yeah.
Get away from the news, right? Enjoy family and real life and not get inundated with everything else that we do on a daily basis. I think it's amazing, but it is good to have you back.
It's good to be back.
Let's start with the Dow Jones Industrial Average. Obviously, this is grabbing the headlines here today. There's a lot to it to unpack and try to understand it. I mean, your first reaction, Matt, is going to be, wow, this is big news, right? I mean, that there's a lot going on here. Whenever you see a big name company like ExxonMobil, when I think of the Dow, I think of Caterpillar and Exxon and these type of industrial companies.
You mean like actually industrial companies? That's what we think about, like companies that actually produce industrial goods and manufactured goods and so on and so forth. It's interesting news. There's no doubt about that. And it's headline news. It's market attention news. It's symbolic in nature. But I think it's far more symbolic in nature than anything else when we're talking about the Dow. I always tell people, when I teach people about market indexes, is you have these four major market indexes. You have the Dow, the S&P, the NASDAQ, and the Russell 2000. And I said, back in the day, back in the 80s, we would track the Dow as a major market index to truly understand where the national economy is going and so on and so forth. And that was back when we were an industrialized economy and not one solely predicated on services. And so it made sense to track the Dow because you had chock full of all these Dow components, companies that built things, right? Companies that produce things, companies that manufactured things to a certain extent and, exported those goods and manufactured products around the world. And so it made sense to track the Dow. But over the course of the last 35, 40 years, our economy has gradually evolved into more of a service-based economy than an industrial economy. And the S&P 500, has been the standard bearer of how we see the market. And I'm not just talking to us at Tackle, but, obviously everybody out there in the market. Ever since, you and I started trading, Tim, it's been the S&P 500, and it's been the S&P for, a good 2 decades. And in fact, the number one ETF of the world in from 2000 to 2012, or excuse me, 2010 was GLD. The number one ETF of the world today that is actively traded, invested in probably one of the number one products to invest in is the S&P 500 itself, with the market index known as the SPDRs, SPY. And so that evolution has been happening for 4 decades in terms of the SPDRs. But, what was interesting though, Tim, is the total weight within those indexes. Yeah. And that's what was shocking to me earlier today when you and I were speaking in the pre-production, trying to prepare for the show, as we were analyzing the importance of this decision. And you said, Matt, the S&P has $12 trillion of money in it, right? $12 trillion. And the Dow only has $32 billion. So we're talking when you think about it from a pure just numbers perspective, the amount of money invested and the amount of shares allocated within the index known as the S&P 500 dwarfs what is allocated within the Dow Jones. So to really kind of answer that question, is this a nothing burger? Is it symbolic, or is it important? I would say it's more of a nothing burger with a little bit of symbolism to it. Like, okay, you graduated, you're in the big boy table, Salesforce. You graduated Honeywell, you graduated Amgen, and so on and so forth. And I do want to get everybody's take on it, but just to make sure everybody's up to speed. Honeywell is replacing Raytheon. Okay, so you have aerospace defense. You have Pfizer getting replaced by Amgen. Healthcare replaces healthcare. And then you have ExxonMobil, a standard bearer in the index for now since 1928, when it was literally Standard Oil. ExxonMobil is being replaced not with another energy company, but with a technology company in Salesforce. Now, I'm not saying anything bad about Salesforce. It's led by a guy that I have a tremendous amount of respect for, Mark Benioff. He's a visionary capitalist leader that I truly respect. It's a company that obviously we like at Tackle Trading. But what in the world is Salesforce doing replacing Exxon? I get it. Exxon Energy is not the flavor of the month. Totally get that. And it's not going to be the flavor of the next 10 years. Totally get that. But how in the world are you justifying removing ExxonMobil, a standard bearing energy company within the industrial index, and replacing it with a tech stock simply because you want more of the flavor of the month? And again, it's more symbolic in anything. But if I'm Exxon, I'm like, well, okay. Mm-hmm. Okay.
I don't know. It's not as cool as when they kicked GE off the Dow for stinking up the place, but
Well, and you know what? I totally get removing underperforming stocks that are fundamentally different than when you added them. And that's why with Honeywell replacing Raytheon and Pfizer getting replaced by Amgen, that makes sense to me. It doesn't make sense to me to replace Exxon.
Mark,
I just would not have made that decision. I personally wanted to.
Mark, what's your read on this whole situation? News, no news?
Man,
symbolic?
when I saw it, I was like, oh my gosh, for 5 minutes in the halftime report, we're going to discuss a non-news story in which we could be discussing anything else.
Are you kidding me? We do that every day.
I know, but this particular subject did not interest me at all. It's like, wow, they mixed it. The Dow's so irrelevant these days. It's like, I mean, yeah, for somebody at home that doesn't follow the market at all, they see the Dow up or down on their ticker. It's irrelevant in today's market. So.
Well, I get that, but let me push back on the irrelevancy of it, because Exxon's down 3% on the day. Salesforce is up 3.57% and breaking out of 210, which is a very important support level or resistance level, which I wish that move would have been done post earnings. But you're right, it might be irrelevant to you, but it's obviously has some symbolism to the marketplace, even though I agree, Mark, 100%. The Dow is minuscule in comparison. Tim, you made the point earlier today where, you look at the total weight in the Dow itself, it's not even as big as the individual components that they added today, not collectively, but separately.
Well,
right?
let me give you some numbers on that, because the total index weighted investment capital is $30 billion. That means things like DIA. Give me DIA, Noah. So an ETF, people investing in index ETFs, or they're investing in index, traded funds, or whatever it might be. They're taking that random walk down Wall Street and they want the Dow Jones Industrial in their portfolio. Well, there's only $30 billion really invested in those types of funds. Globally, the bigger funds are the S&P 500, $12 trillion. So about 350 times the amount of money is invested in the S&P than the Dow. And what makes that noteworthy, in my opinion, getting added to the Dow, Salesforce, index fund managers are going to have to buy some Salesforce.com. Supply and demand, right? You have more demand for a product, including a stock, it might create a little pop. But the demand needed to rebalance their index weightings is only about 1 hour of trading on the average trading volume of Salesforce.com. Salesforce is a $200 billion company in and of itself, right?
Yeah, it's only 6 times bigger than the Dow is.
Now, a percentage of a small amount of money has to be invested in Salesforce. Is not bad news. Don't get me wrong. It's not a bad thing, but it's just not, it's not a story,
No, well, let me push back, because I do think it is a story. I do think it's a story. I think it's symbolic in nature, but I also think it goes to the lack of logic and critical thinking that happens within the Wall Street mechanics in general too. The reason they wanted to add Salesforce and remove Exxon, which again, Exxon has been one of the standard bearers within the index for literally over 90 years now, is because the percentage of weight that Apple enjoyed, and Apple's not even a tech stock, guys. I don't care how anybody tries to categorize them. They are a consumer discretionary stock. They're an industrial stock. They're a retail stock. They're a tech stock. They're literally, their umbrella encompasses all of them. But because it was officially categorized as tech within the Dow component, they wanted to add a tech stock, because Apple, it was 27, or not Apple, but technology stocks as categorized was 27% of the Dow weighted index. But that is only 27% because Apple's up 70% year to date. And so because Apple had went up so fast, in such a short time period, the weight of the index was a little bit more heavily weighted to tech than other areas of the Dow. So instead of looking at Apple in non-technology eyes, they simply wanted to increase the percentage of the index within technology, because by removing Apple, not removing, but the split will move it from 27 down to 20% within the weight of the index to be tech. By adding CRM, Salesforce, it goes back up to 23. But what you're doing is you're removing a industrial energy stock and adding another tech stock. They were so fixated on the percentage of technology within the index that they literally made the decision to yet again remove an industrial component of the within the weight. It lacks logic to me. It lacks rationality to me. It literally, to me, it feels like Wall Street's just chasing technology, and honestly, removing Exxon, I do not believe it is a logical move by the Dow to remove Exxon.
And even if it is, why Exxon and not Chevron? That part doesn't make any sense to me. Exxon's bigger. They're the stalwart. They've been there for 100 years, Mark. It felt almost like arbitrary, quite frankly. I mean, why would the Dow pick Chevron over Exxon?
Mark?
Well, I mean, it's nuances, right? Like when I read message boards between Chevron and Exxon, there seems to be general current sentiment geared toward Chevron over Exxon. When you read that might have filtered over into the discussions. I mean, it was arbitrary though, to some level, right? Because if oil is there and people are using energy 20, 30 years from now, the companies are going to be relatively the same.
Mm-hmm.
Oh,
I find
Nicholas, I would not have replaced Exxon. I would not. I would not have removed Exxon. I don't think they needed to remove Exxon. So it's not like I would have rather had somebody else. I never would have added Salesforce and removed Exxon. If I had to make that choice and I was removing an energy component, which again I would not make that choice, I would have removed Chevron over Exxon. But I will tell you right now, there is not a discernible difference in the fundamental nature of Exxon versus Chevron. It is personal preference.
Mm-hmm. It grabbed my attention first this morning. There's no doubt about it. Made me want to dig into Dow history and all that kind of stuff. I mean, the Dow's been around since 1896. It was the very first index created, very first tech company to be added to Dow, Matt. I did look that up as well. IBM, I believe 1976.
Yeah, I would have removed IBM over Exxon.
Sure. Or yeah, remove IBM, add Salesforce. That would make sense. I got no problem with that.
Are you kidding me?
Yeah,
that would have been an easy one.
Yeah. Well,
what company would I replace over Exxon? I would have replaced Dow Chemical. I would not have replaced Exxon over Dow Chemical. I would have removed. I probably would have removed Boeing over Exxon because of the risk associated with Boeing. I would have removed Caterpillar, Nike, McDonald's, Home Depot. Hell, I would have kicked out WBA. I would have kicked out WBA. I know they were just added in 2018, but come on, they're what are they down 40% since they've been added to the index? Kick out the underperforming. Kick out WBA, Walgreens. I would have kicked out Walgreens. Pfizer, I definitely understand removing Pfizer for Amgen. Coca-Cola, Walmart, Procter & Gamble, Merck, Johnson & Johnson, JP Morgan Chase. All of them are fine. Verizon, Intel. You know, I would have kicked out Intel. I would have kicked out Intel. Let's go. If we're going to chase the dreams of tech, let's kick out Intel and let's add AMD. Let's do it. Let's get it on.
Pruning is to remove the bad leaves and the bad stems, not the good ones. This doesn't make any sense.
So Intel's garbage. So
Intel's, yeah.
That's all I was saying. So remove Intel. I'm agreeing with Matt here. If you're going to prune an index, then prune the index like based on some fundamentals and some performance over the past.
I don't think you can make the case for AMD over Intel, but I can make a case for Taiwan Semiconductor over Intel.
Well, I was being sarcastic in the AMD.
I know, but you made me think Taiwan. I'm like, Taiwan's a better company than Intel.
And they're going to have a foreign-based company in the Dow.
Oh, you can't
happen.
No.
Well, I don't know if you can or can't. I just think it would be bad. It would be optics would be bad. But again, what would I replace? Just off the top of my head, going through it, I would have replaced. And again, I would not have removed Exxon, and I would not have added Salesforce. Okay, but if I were to make that choice, Chevron, Boeing, Dow Chem, 3M, WBA. Let's go with Travelers. Maybe not Travelers. IBM. Let's go with Intel. I would have removed all of those before I would have removed ExxonMobil. But again, I would not have done it. I don't think you needed to do it. They were chasing the dreams of tech.
Is there any symbolism here for you, Mark? ExxonMobil being removed. I mean, obviously energy, this is not just Exxon being removed. It's less exposure in energy for the Dow weighting and whatnot.
Guys, there's only one energy stock left in the Dow. Only one.
Man, I mean, I think it's symbolic, sure. I mean, I think most of us believe that the world is going to be less traditionally energy reliant 25 years from now. So I think there is some symbolism there, sure.
What were the original 12 companies on the
Energy still runs the world. It still powers the world. I've said many times, I believe in the ESG movement. You should invest in that movement. Energy will have less consumption 10 years from now than it does today. But oil is going to be play a major role in all of our lives for the rest of our lives.
I think it's a cool story. It might just be cool for us trading nerds, by the way. We love stuff like this. It's like debating fantasy football players who you should draft in the first or second round. In terms of the actual market impact, I don't know. I have had curious.
By the way, I would draft CRM before XOM.
I would take CRM before XOM.
Bigger, higher upside, man.
There's no doubt about it.
Higher upside.
Yeah, it's a good pick. It's a good pick. Why does the news
going
still
Tyreek Hill? Home run potential there, buddy.
Mark, if the Dow's only 30 companies, it's only $30 billion invested, it's nowhere near the S&P 500 index weighting. Why does financial news media always center around quoting the Dow first? I mean,
I think it's tradition. I mean, even like when I was like, I remember driving around playing poker, and I wasn't trading stocks back then, didn't have any interest in it, don't really know anything about it. And that's the only headline that would ever come up was the Dow. The Dow. I mean, that's 20, 25 years ago. And I just think there's just this tradition with the Dow. I think still in the minds of many individuals who do not associate, trade actively, the market is the Dow in a lot of their minds. So I think there is just this tradition to non-market participants that is still pretty strong.
Dow 28,000 right now. We've got a new shakeup, new lineup, whatever you want to call it here. Noah, give me a technical read on that while we're on the chart. And then let's move on to the S&P 500 if we can. And mute there, sir.
All right. Well, you got it breaking these recent highs and kind of poking its head up above that 28,000 level. It still has the old highs out at 29,543, which I suspect it'll be testing soon within a week or two, maybe 3. But it's got a nice little breakout and a retest right there, coming off of that kind of moving average cluster, the 9-period moving average. And today's action's a little soft, kind of poked its head up and getting smacked back down. But for all intents and purposes, it looks like it's still trending upwards.
Mm-hmm. Very similar candle, by the way, on the S&P 500 today. And, we're talking, many of these companies we're talking about are also in the S&P 500 as well. Let's move on to broad market analysis here for a bit. And let's start talking about this. Obviously, a very different chart, much stronger. It's got a breakout up here at the all-time high. We're carrying through for a day. Now, Noah, I don't know if you caught this headline on your drive home, but the S&P did hit the all-time high yesterday, continuing that today. Quick technical read there, Noah. And I know tonight you're going to be in the Coaches Show, right?
Yeah, we're going to be talking about targeting techniques and how we can use them with both stock and options. And anytime I get a big breakout, especially of an all-time high, Tim, one of the first questions in my mind is, well, how far can it go? Like, what are the probable targets? And at this point in time, you got a breakout, really strong energy on the first day of the breakout. Today, you're seeing it lose a little bit of that momentum with the long upper shadow on that candlestick, almost doji-like at the moment. It'll be interesting to see which way that closes, but we were talking about different targeting techniques, and the first thing I think my eyes are gravitating towards on this breakout is just 3,500 for no other reason than it's that fat number, and the market has clear air of, at this point in time. We might see a retest before it pops up and takes new highs, but it's closed above that, and if it can stay and close above there, a day or two more, that's a good sign of confirmation for would-be buyers who are a little tentative prior to the breakout.
Mm-hmm. Hey, I had a question for all of you, and I spent a few seconds on it, and I wanted to save it exactly when we were talking about this. I was doing my morning chores this morning, and I was thinking about the broad markets, and I was like, is there a chance the S&P 500 goes parabolic? Because from a computerized algo trading thing, we have seen this, like things get above resistance levels, and then because there's no short selling, because there's no resistance, we just see, we saw it with gold, we saw it with silver, we saw it with a million individual stocks. Is there a chance the market itself, in this general pattern of getting into resistance with lack of technical resistance levels, just has a parabolic algo-driven move?
Mm-hmm. Matt?
Regarding if the S&P has the ability to go parabolic?
Mm-hmm.
Yes.
Yeah. You literally just broke out of the all-time high at 3,400. There's literally zero resistance in front of it in any capacity. I don't think it's likely that we go parabolic here. I think it's more likely that we standardize type trend coming into what Noah was talking about at 3,500. But can the Dow, and not the Dow, I'm still stuck on the Dow. Can the S&P break out of that all-time and run? Absolutely, 100%, especially given the fact that over the course of the last 2 weeks, you've really consolidated their mark in the marketplace. RSI isn't undervalued, but you've kind of consolidated, came down into about 78. But look at this from a bigger picture to kind of answer that question. Let's go to a weekly chart really quickly.
Mm-hmm. And while we do that, define parabolic, Mark.
Well, I mean, the type of movie, let's use
pandemic, economy reopening from May to June.
Okay.
Mark, would you consider that?
I like even like I mean, parabolic for me is relative to what normal price action is by a large percentage, right?
Mm-hmm.
So I'm not talking like Kodak when it went truly parabolic from like $5 to 60 in 2 days. I'm talking more like gold and silver's huge, massive, relative to normal price action upward run that it had for that 3-week period.
Noah's got a picture here.
I just wanted to find parabolic. We got a parabola.
Okay.
It's
gotcha.
I could see it flying steep. Like when you don't have any overhead resistance, I think the big question for me is, are there sellers? Because you got money printing, you got people looking to put it places, market breaking a high. If you get a reopening, I think that can fly, and the algos could certainly drive it. It's question in my mind is there going to be supply to suppress that price run?
Yeah, I'm trying to think through this. It's a good question, Mark. A very interesting question, because obviously a big move in the market is definitely in the cards at any time whenever you're breaking into an all-time high. Matt, you brought up the weekly chart. We've seen just an incredible run here from the bottom to the top here, 2174 all the way to 3448. So we've caught a breakout. We've had a lot of momentum in that breakout, but that momentum is slowing down just a little bit here. I mean, Matty, what are your thoughts here?
Can it go parabolic above the all-time high? Yes, I certainly believe that it can go parabolic. Do I think that's a probable outcome? No, I don't, but it certainly can.
When I'm not crazy, basically.
I don't think you're crazy. I don't think you're crazy. When you look at this on a weekly chart, you're seeing something overextended. And you might be like, the weekly chart's a little overextended. And yes, we are looking at that V-shaped recovery that could lose some steam as it's getting overextended, especially in the face of some economic reports and consumer confidence that were not very good today, but that was just today. But take a look at the monthly chart here for a second, guys. And I know we don't look at monthly charts very often, but I think it could give you a little bit of a different perspective.
Mm-hmm.
Hold on, I'm looking at YouTube's. Okay, there you go. When you look at that monthly chart, guys, and you look at the gravity of the drop that we had in March and April, and you came down into those historical support levels, but when you look at it in over the vein of since trade war policy, 2018, 2019, 2020, taking into account the pandemic, you really have not seen massive price appreciation since the end of 2017, guys. Really, you really haven't. You had that massive run up on the corporate tax policy in 17. And then basically you went neutral for a good couple years before you had the blow off top right before the pandemic, and you were starting to really cook right before the pandemic. The pandemic hit, markets got smacked back down. When you look at that just from a visual perspective, guys, and you compare that visual perspective and you take it and you discount the news that impacted that, trade policy, pandemic, so on and so forth, and you look at that in comparison to kind of those price performances in the subprime market crisis and the price performances in the Dow Jones. Both times when you broke out of that historical resistance chart on the monthly chart, you did go parabolic, guys. Mm-hmm. You did. When you broke out of that chart there, and I believe it was when did we break out of that? 2013? When you broke out of that in 2013, the Dow ran, not the Dow, I'm still on the Dow. Oh my goodness. The S&P ran a good 25%, guys, in the next year. And so you're breaking out of that all-time high. That monthly chart, in at least in my opinion, is not completely overextended the same way you got in the same capacity that you think in terms of the daily chart and the weekly chart. And so you're breaking out of that all-time high. There's no resistance there. Taking into account the last 3 years of basic neutrality, very volatile, but basic neutrality, yeah, I mean, you can run here.
I definitely agree you can run. I guess it's all semantics.
Now the question is,
parabolic. What is parabolic?
Can you run in front of an election?
And without a stimulus bill, or, you know, who knows?
Okay, let's just look at the election, because I think a lot of people are really fixated on this election and the importance of the election, and I don't want to discount that. In looking, because guys, and I could be wrong here, but I kind of feel like we always think in terms of this moment in time is the most historically important moment in time. And we say that in every single situation of history. We said it in 2012, we said it in 2008, we said it in 2004, we said it in 2000, we said it in 1992, we said it in 1980. You know, so we in a lot of times politically, we get into these moments in time where like, this is the most daunting, most important moment in history. And yet we say that all the time. And so in terms of the data from an election perspective, the 2 months previous to an election, okay? And I'll just give you the data to kind of indicate whether or not we can run here. In 2016, the 2 months before the election, which again was the latest time this was the most important moment in our history. In 2016, the S&P rose 46 points, or about 2.1%. Okay, so in 2016 we saw price appreciation in the last 2 months at about 2.1%. In 2012, you basically went neutral. In 2008, you went down 24.5%. In 2004, you went up 26 points, or 2.3%. In 2000, you went down 81 points. In 1996, you went up 66 points. In 1992, you went up 4 points. In 1988, you went up 19 points. So in terms of the percentage movements, you're talking the 2 months previous to an election is 2.1%, 0.5%, 24.5%, 2.3%, down 5.3%, up 10.2%, 1%, and 7.3%. So if you discount the 2 moments in time we were going through massive recessions, the subprime market of 08 and the dot-com of 2000, if you discount those 2 moments in time, you're really talking about net neutrality before an election, the 2 months before an election. So the market doesn't like to, you know, price things in until they really see the results. Remember, the market does not like certainty. Now, the 2 months post an election, right, we see a little bit of a different picture. In 2016, the 2 months, November and December, post Trump's election, the market went up 100 points, or 4.7%, which was about twice the amount of that we went up the 2 months before the election. In 2012, the market went up about 1.5%, which was a little bit higher than what the neutrality that it had before the election. In 2008, the market went down 6.7% post-election. And again, sometimes these numbers get skewed because you look at, okay, Obama gets elected in 08, the market slows its momentum. And that had absolutely nothing to do with it. The central bank literally announced a massive quantitative easing program. That's why the market kind of slowed its momentum. In 2004, the market reversed course when President Bush was reelected in his in the second time, and it went up 7.6% versus the 2.3% it went up before the election. In 2000, it actually contracted 7.7%. 96 went up 4.7%. 92 4.2%. So what I'm seeing in the data is, honestly speaking, the market goes neutral before an election, for the most part, goes neutral before an election. And then you see a little bit more volatility post-election, but it's not substantial. So to answer the question, in the face of an election, can you go parabolic, breaking out of the all-time highs? Yes, you can. But history suggests the market doesn't want to take a position one way or the other until post-election.
Well, and then even the year after, Matt, I think in general, I mean, markets have been mostly bullish whenever anybody gets elected.
Okay, markets are bullish 80% of the time.
I know. So what was your takeaway from all this research? I was on the phone with you while you're doing a lot of it. How did you interpret what you saw as you were going through these numbers?
Well, the data suggests from an election perspective, neutrality coming into the election, and then an increase in volatility post-election. That's what the data suggests. Regarding the data suggesting the market prefers one party over the other. There's no data that supports that one way or the other. It's very mixed. And if you put it into the light of those moments in time of central bank action, that really throws a wrench in any of the analysis. So what the data suggests to me is that we as people, because we're emotional about this, we assume that whoever the president is has a greater influence on market price than what it really does. The central bank, and I know I'm a broken record on this one, but understanding central bank policy and doing back testing of historical perspective, it really does lead you to believe that the central bank is the chief responsible for when prices go up and prices go down.
You know, Marky, in your newsletter that we talked about and we did a podcast on yesterday, one of the things that you did cite was a potential election risk. Now, I don't think it was at the highest of your thing, but it is still something in the, you know, in the consciousness right now of investors that they're assuming there's this big election risk. I mean, do you still feel there might be one there? Do you think this time might be different than the data that Matt's talking about? I mean, what's your read on this?
I think the general populace ranks the election risk much higher than anybody that goes deep into the number. I mean, I think the real risks deal with the systematic risk. The short-term risk, I think, is a technical sell-off. The intermediate risk is a realization of how bad the economic data and the reality is. And the long-term risk, inflation, debt, lots of other things. I mean, will the election be a news story? Sure. If the Dems sweep, will there be a day or two, whatever, where people are like, oh, corporate tax cuts, sure. But then the Fed comes in and says something, right? But I think in the grand scale of the million bear arguments, I think individuals think and worry about election risks far more than the big picture.
Well, and Mark, I'll even take that a step further. I don't think the market truly cares one way or the other at the president's side of it.
The market cares about money.
I really don't care because money spends.
You know,
but
because
I do believe, hold on, let me finish my point now, then I want to get your take. I do believe the market would care if the Democrats have a sweeping victory within the Senate as well. Because if you have a mixed government, that is going to curtail some of the spending from one party over the other. And so if the Dems, and again, this is just my opinion, but if the Dems win the presidency and win the Senate, because they're widely slated to win the House. So if they control all three phases of that from a lawmaking ability, I think the market would be a little bit more concerned at that point. But if Trump remains the president or Biden takes the presidency and the Senate does remain Republican, I think you at that point you curtail some of that concern to a certain extent.
Yeah. Well, I mean, I think like. I think the only thing they care about really at the end of the day is the corporate tax cuts, and will Congress, Senate, Republican, whoever's in office spend money, more fiscal stimulus, more free money, more. I mean, I think that's the only thing they care about at the end of the day.
Yeah.
So.
You could even make a case though, Matt. I mean, if the Dems win the Senate, the House, and the White House, that they're just going to flood the market with stimulus money. So
no, money spent. Money spent.
Right.
No, and that's why.
What about if they win all three branches that they could remove the tax cuts to 2017?
Well, that's what I mean about the corporate tax rollbacks.
Well, and that's why I said if the Dems sweep, the market has a little bit more concern. But you really think Mitch McConnell's going to put anything up to a vote at the Senate level regarding a reduction in corporate taxes? This is the same man who basically stonewalled a Supreme Court justice for 10 months during the last year of Obama's presidency. I just don't think McConnell would do that.
Yeah, I mean the only theoretical risk is a Dem sweep because of the corporate rollbacks and taxes. So.
But again, even in a
filibuster, they've been pushing to remove the filibuster. Then there's nothing the minority party can do to stop it. Well, if they did that and won all three branches, there's no stopping whoever's in charge.
Again,
51% controls every 49%.
Fantastic, but again, we're talking about market expectations here.
But if they were to spend and add more to the economy, but also increase the corporate taxes, I think it's just going to increase volatility all over the place.
The only thing
I think it has a much bigger impact on sectors than it does the broad market.
I think the way the market really responds to any of this stuff is uncertainty is not good. So if you have any of the outcomes you talked about, Matt, they're not going to like the uncertainty. But then again, I mean, here's the reality. We usually get a rally post-election. The data is very inconsistent. I do think that the public is making the market response to the election to be a bigger deal than it probably is. I agree with you. And
that's what the data suggests
on that regard. And don't get me wrong. I mean, everybody's got their eyes glued to this political process and the election, all that kind of stuff. It doesn't mean it always has an impact on stock prices. We're talking about a $20 trillion US annual GDP and a market that is much bigger than the impact of something like that. We're breaking out. Can it go parabolic? Man, it wouldn't shock me. You look at that trend. One of my favorite charts, Noah, ever. Look at give me SPX.
Well, and that's the one thing with
can it go Kodak?
That is the one thing with the S&P 500, guys, is in these, and this is the one problem you have with seasonality to a certain extent, is in a lot of these moments in time, you had historical situations from central bank policy or fiscal policy or whatever the case might be. But in a lot of these moments, we weren't talking about breaking out of all-time highs in an environment where we were flooding the markets with money.
Mm-hmm.
And so this is a unique situation given how much money we are putting into the markets. And, you know, to go back to can the market go parabolic? Yes. I don't believe it's going to, because again, data suggests neutrality, you know, the 2 months before an election. But again, we just broke out of an all-time high, guys.
Mm-hmm.
No, I mean, but the thing about it is that has me thinking about it is not traditional sentiment. It's that the computer programs are broken. And you see that, I mean, we've seen, I mean, remember that Chinese fintech stock that people mixed up with Fang. I mean, we've seen it in Hertz for short periods. We've seen it with Kodak for short periods. We've seen it with Genius Brands for short periods. I mean, we've seen it, and we saw sizable runs in gold, in silver. I mean, when Apple and Tesla announced their stock split, I mean, there was just this computerized, just lift off, gigantic run. And so we're seeing these abnormal things. And so it's like, if there is some news story that broke, because almost all of these, well, not the Chinese fintech stocks, have some kind of catalyst behind them, some little news story. And it just has me thinking that, man, you could see something in this gold type run because something sparked. I mean, it's just 2020, man. It's prep for anything, right?
Well, and honestly, Mark, a lot of the historical models that have been blown out of the water in this market cycle, you know, this market cycle that has been very consistent for 100 years. I mean, we're seeing unprecedented monetary policy, but we're also, I mean, you got to put into the analysis the algorithm overloads, right? How does the algorithm overloads price in volatility and whatnot? So, I mean, there's obviously there's a lot new here, but you got to use history as a gauge, and history suggests net neutrality coming into an election.
Algos and no resistance is the only reason why I'm not saying no to Mark's question, because my first thought was, how much capital would it take to make the S&P 500 go parabolic? We're talking a lot. You know, this is a huge index, right?
Well, let me give you some numbers. Does $7 trillion in balance sheet, does that help?
Are we going to get 7 more?
You're gonna get 3. Hey,
well,
listen, guys, you better get prepared for perhaps the most dovish speech a central bank president has ever given this weekend.
Mm-hmm.
You better get ready for that.
Is it? Okay? When is he speaking?
Team tackle. I'm warning you. I will be on edge next week, because this is going to be the most dovish speech in the history of the central bank on Friday. So can they go another 7 trillion? Here, let me match and go another 14 here. So yes, if he comes out with as dovish speech as I think he's going to give on average inflationary targets, and the market anticipates that or understands that to mean extremely dovish monetary policy for the future.
Mm-hmm.
Yeah.
And is he speaking Thursday, by the way, Jerome Powell?
I don't know if it's Thursday or Friday.
I'll have to look that up. No, while you're here, just one quick thing I wanted to do before you left this chart. Go up and change the time frame on this chart manually. You know how you can do that in Thinkorswim? and go to time frame and do max available on the monthly candlesticks all the way down.
Cody, and while you guys do that, I do have a question for Cody. Cody, do you think that's one thing all of us Americans can agree on is the elimination of daylight savings time?
I think so. It might
I
be
think that's one thing.
thing.
Could that be the unification that I speak about to unify all of us Americans, like the elimination of daylight savings time?
Well, wait. Could we hold off till spring? Because fall back's not bad. Spring forward, that's bullshit.
Well, that's actually what it is. It's actually now is when we're the winter is the correct time. So I agree. You know, like we got to go forward and like let it change and then get rid of it in spring.
This all sounds like a liberal hoax to me.
It's an antiquated idea. I think we should get rid of it as well. This is my favorite chart to look at, by the way. I think that so many times I talk to traders, new traders, even people who get wrapped up in the moment, whatever it is, and they're like, oh, this time is the most important thing we've ever done in our lives, and you will never come back from this, or whatever it is. Context matters. This chart goes back to 1929. And you look at what happens over time, markets go up. Mark, this is one of the reasons why you are a long-term bet on the house kind of guy, like we talked about.
Absolutely.
Yeah. You know, even the crash in 2000, biggest tech bubble crash ever, right? It's a blip there. It's notable. We remember it, of course. The 2008 financial crisis. You see these drops in markets. Sure, they happen. And they will happen again in your future.
Dude, in 1932, at that bottom, there was some kid in a classroom screaming at his schoolmate, "Buy the freaking dip, you wuss."
I'm not sure that was actually happening, but that was funny.
Jesse Livermore started trading when he was like 12 years old. So it's not out of the realm of possibility.
Well, he started in the bucket room.
He was also he was greatest.
Jesse Livermore coined the phrase "buy BTFT." That's what he did.
Yeah, although Jesse Livermore made all of his money shorting the market, but
he had to sell it to somebody.
Yeah, so I mean, again, context matters, since Jesse Livermore made his fortune shorting the market. But context matters, Noah. When you pulled up that chart for the first time, it was like a flat line, right, on like the first 80 years. Mm-hmm. But then when you scale in, you look at like the Great Depression, you saw 90% dips in price, and yet market recovered over time. You got to bet on the market long term. Absolutely. There's spots, right? There's spots where you have great opportunity on the short side, but I don't think we're there yet here.
Yeah. No, in fact, we continue pushing towards new all-time highs, and the S&P up here at a breakout. Good question, Marky, and I love the data that you gathered on that election stuff, Matt. I mean, I think sometimes we have this question, we have this instinct, we're curious. Go get numbers, go actually do research and try to understand something. I think it's a good lesson in trading and investing. Let's move on. Let's talk economics here for a second. Noah, give me Forex Factory, or even just back on the market. There were two data points. I think the consumer confidence report was noteworthy. Maddie, give me the numbers on consumer confidence, home sales, and what your read was on both of them.
Yeah, consumer confidence numbers came in at 84.8 versus the expectation of 93. Last month was revised downwards to 91.7. So, you know, one of the open questions we've had in this recovery is how does consumers come back and participate, and how do they participate with their disposable income? Mm-hmm. And consumers are obviously right now a little bit concerned, and the concern is, I think the lowest number we had since, I believe, Mark, was it 2014?
2014 was
the last 2014, and it took consumers a while to get their confidence back post subprime market crash, obviously. And so, I mean, it just shows you what we've all kind of assumed, that the consumer, regardless of what the government does, regardless of what the bank does, consumers are going to play a role here, and their confidence has been waning. There's no doubt about that. But the reality is they're still spending the money. It's just on what they're spending it on, right? And so consumers are showing a little bit less confidence today than they would be. I don't think anybody should take too much into this report, just given the fact that I think that's kind of, at least to me, it was kind of expected. So I'm not reading too much into this report, I don't think. New home sales came in, and we just saw this last week. We saw it last month. We saw it the month before. It has just been so stinking impressive to see how home sales have held out over the last few months. And obviously we talked about the concerns we have for 2021 and taxes and all that jazz in regarding to home loans and whatnot. But as of right now, I mean, you want to talk about euphoria. You've had some euphoria in existing home sales. New home sales came in at 901,000 versus the expectation of 787,000. Last month was 791,000. And just to give you a little bit of context there, guys, that number's on new home sales, that number's the best number we've had since the subprime market crisis of 2008. The housing market has been it has held up extremely well.
It's so impressive on housing, no question about it. I mean, out of the one area of economics, Matt, we track the data here and we go through the reports quite often. Housing's been the strongest in the rebound, right? In terms of this year. But man, that consumer confidence number, it's not a good sign for the V-shaped recovery, obviously, this idea of a V-shaped recovery. I mean, that's what was the stat you gave, Mark? The worst number since 2008?
2014.
2014. So yeah, I mean, I get it, but economic data, as it continues to come through, keeps painting a picture that whole dream of that V-shaped, Matt, is probably a fantasy. There's no question about it, in my opinion, and that we are going to have some continued problems in the economic data.
No, I don't. I don't believe in the tooth fairy, and I don't believe in V-shaped economic recoveries built on literally nothing.
Yeah. When do you tell your kids that the tooth fairy is fake?
Well, I didn't want to say Santa Claus just in case some kid was. I mean, the tooth fairy is different than Santa Claus.
If we get an email to Team Attack Trading, you destroyed my child's dream.
I am sorry. I'm not going there. Tim, don't ask me that question.
All right,
dude. I want to see the video of the kid who the parent tells him, and the kid looks at him and says, "No, I don't think you're right. I think he's real." Pushes back on the parent.
You're just messing with me.
You Mom. Just had. I might as well tape me and Kat's conversations.
Well, I mean, that's what the Fed's been trying to tell everyone that this is not a V shape, that there's problems, and nobody seems to listen. So the Fed's been trying to tell everyone that this isn't a V shape.
Sure.
Oh, they've been consistent on that. They've been saying this is going to be a prolonged recovery, and people don't want to hear it.
People do not want to hear it. More money.
By the way, while you were talking about the Fed a minute ago, give me the dollar if you can here quick, Noah. I also saw, did you see the op-ed piece from Janet Yellen? I didn't read it. I saw the headline.
I saw the headline, read a little bit about it. Let me guess. Janet Yellen, and again, I just saw the headline. Janet Yellen is basically saying the central bank is good and the government is bad, and the central bank has done everything they need to do, and the government needs to step up and play their role.
That's right.
Okay.
Yeah.
Done.
Congress needs to print money because the Fed has done their job, basically.
No. The Congress doesn't print the money.
Well, then
Congress needs to. So let me get this straight. So a former central bank president is telling the government that they need to borrow more money from the central bank's printing press. Mm-hmm. That's okay.
Mm-hmm. Mm-hmm.
Okay. Thanks, Janet.
And the same woman, by the way, who said we'll never see another recession again. We're currently in one. I think at least until the recession's over, Janet Yellen should probably not give op-ed
speeches.
Don't
talk.
I mean, maybe when we come out of it, we can. The dollar continues in a downtrend. There's not much there. It's going to be interesting to watch Chair Powell's speech later this week. And Matt, I bet the number of times that you're going to want to get up, leave the room, and stomp off because he said something crazy. Over under on an hour speech, I would say probably about 10, at least. 5.
I would put it over under 3.
Yeah.
The amount of phone calls or text messages you get, 10.
Oh, you'll call me. We'll be talking. There's no question about
definitely
that.
10.
We'll talk.
I obviously I'm going to be glued to the television watching his speech and trying to understand what they're trying to do. Like I said last week when the minutes came out, I think the Fed is trying to find a way to properly communicate with the marketplace, mm-hmm. especially as we've been going through some very, very unprecedented situations over the last 6 months. And so I think the Fed is trying to find a way to communicate properly without spooking the market and fear mongering. I'll be watching the speech and trying to figure out a way to interpret the new Fed. But the average inflationary target, guys, that substantially changes the mandate of the Fed. that substantially changes the mandate of the Fed, to the point where this speech could be the signal of what answers that question of, you know, the future of monetary policy for the next decade. And so that speech is not just going to be widely followed by me, it's going to be widely followed by other central bankers around the world, by other governments around the world, to signal what the central bank of the United States, which is the most important central bank, because every other central bank kind of creates their policy off the United States central bank. So if they are truly going to change to an average inflationary, because so far, Tim, we've just seen speeches on it, we've seen speculation on it, but we haven't seen a concrete policy shift yet. And so, yes, I will be looking for, if this speech is utilized to change the mandate of the Fed to an average inflationary target instead of a 2% target. And what that means, guys, is they're going to create a monetary environment to target above 2%. Everything so far has been to try to target 2%. Now they're going to adjust that to target above 2%, which means extremely dovish monetary policy, circa what Japan has done in the last 20 years. But if they were just to give me 2 minutes give me 2 minutes of speak time in the Jackson Hole virtual conference, I would tell them, if you want to get 2% inflation, reduce your balance sheet by 90% and just give people money. Because if there's one thing we have realized in the last 6 months, is when you give people money, what do they do with it? They spend the money. Yeah. And guess what? It goes to those same corporations they're buying corporate bonds of anyways. And so if you want to create inflation, stop gift wrapping trillions of dollars to banks and corporations, which park it into stock buyback programs, increasing dividend, and park it into their savings accounts called stock positions that create zero economic value and zero velocity of money. To create that inflationary impact, reduce your exposure on the balance sheet, curtail the spending you're doing, and target the middle class instead of the 1%. Because if you target the middle class, you bring up the entire all classes you bring up. If you target the middle class, you bring up the lower class. If you target the middle class, you make more money at the corporate level because money spends. But right now, the Fed is targeting the ultra 1%, the banks, the corporations, and their balance sheet has now exploded above $7 trillion, which is increased over $6 trillion in 10 years. And in that time frame, we're seeing 1.7% utilization of money, versus in the 1980s and 1990s, when we didn't have these disastrous monetary policies, when we had regulations on the banks called Glass-Steagall, you had a 3 to 4.5 utilization of money in that environment. And Paul Volcker and Alan Greenspan, who are two of the better central bank presidents of all time, they never had to worry about the inflationary impact to the degree that they do today, because they didn't just donate money to corporations in the top end of the market. The velocity of money is if you're truly seeking that 2% inflation, and you use Japan as the historical case study, you got to stop your horrific monetary policy that is so destructive to the middle class from an inflationary perspective, and reduce your exposure, reduce your balance sheet, reduce your quantitative easing, reduce it by upwards of 90%, target the middle class, and then you create velocity. Because again, I've said this for 10 years, but if there's one thing we've learned in the last 6 months, is if you target consumers, regardless if consumers are happy or sad, you target consumers from a monetary perspective. Consumers spend money. It goes to the top of the market anyways. Apple still gets their revenue. What have we seen about Walmart? What have we seen in every retail earnings report? Retail, yeah. Every single one of them increases in revenue, and you didn't have to bail them out. You didn't have to give them money. You could have simply stimulated 80% of the base, which is the middle class, and middle class spends, middle class goes into debt, money goes to the top of the market, and all of a sudden you have your inflationary 2%, but you don't worry about hyperinflation in that capacity. So That's what I would say, but they're not going to call me.
I would love for them to call you, and I would love to be able to sit down and hear you have a conversation with Jay Powell. That would be one of my favorite things that would ever happen. But no, I don't believe they will call you, Matt, even though they should. There's no doubt about it. Matt,
listen, they're going to do everything they can to keep up the house of cards they have created and the bullshit Ponzi scheme they've been pursuing for the last 12 years. That is what they're going to do. And that's what this average inflationary target is about. It is putting a massive tax on the middle class. It is a destructive monetary policy to 80% of all Americans, solely so that they can keep up their nonsense house of cards. It's ridiculous.
Yeah, I agree. By the way, you got an ongoing conversation in the chat here I want to address and, kind of answer some of the questions. Bring up breaking news on DraftKings, by the way, Mark, this will grab your attention.
What happened to DraftKings?
There's a couple of things that happened here. There was a conversation that might be a buyout target. That's actually not what I'm reading in the news. Here's what I gathered here for you guys. And obviously a big pop there today. Interesting pivot developments. So there was an analyst that came out and reaffirmed their rating, but that's not actually the news. Illinois Governor J.B. Pritzker actually reinstated an executive order today, Mark, allowing people who live in Illinois to sign up for DraftKings on their app and make and place remote bets, even from Illinois, even to a casino in St. Louis for Illinois residents. Now, the analyst was
DraftKings.
Very good news. They represent this guy thinks it's a $700 million opportunity in Illinois because of the number of people who live there, major metropolitan area. And one of the things the app does, this is really interesting as I was reading this, 75% of the revenues in the app are for in-game betting, Mark, something that as an old, football bettor and all that kind of stuff, I know you like laying those halftime lines, things like that. They're going to be authorized to do that while they're watching football or soccer or whatever it is in the state of Illinois. So that was the news here today that I picked up on. Matt, it's good news for DraftKings.
That's the argument for DraftKings right there. That's the entire argument for DraftKings is state after state after state over the next 10 years is going to legalize gambling because, Tim, has nothing to do with the moral conversation. This is a numbers game. A state like Illinois, with a massive risk to their pension plans from an industrial perspective out of Chicago, they see the ability to get massive taxation on this. And it's the same thing other states are going to see. This is very positive news for DraftKings, in my opinion.
Mark, DKNG has been one that's been on your radar for a while now. Obviously, I mean, we've been talking about Penn National Gaming, these other casino stocks. Reaction to the news, number one, the chart, and just what your thoughts are on DraftKings.
Well, I mean, when you have a long-term view, and plus from a technical point of view, you broke through some resistance there, which DraftKings have been fighting for about a month. The space, the long-term space, when you develop a long-term thesis, right? Short-term, we trust technicals. Long-term, you develop a thesis. And I think we've talked several times, we all like the online betting space that over the next 5, 10, 15, 20 years, as states look for new ways to create revenue. And I mean, this is about what we're talking about for 3-4 months now. They're going to turn to online gambling because it's a natural revenue source, right? And so that's the long-term thesis. And I think that plays out. I think you all think that plays out. And so it's all a matter of how do you want to play the space, right? You got BetMGM, you got Penn National Gaming, you got DraftKings as 3 of the big ones. I like messing around with all of them. DraftKings, I mean, from a valuation standpoint, it's ridiculous. This is truly you're betting on the brand name going into the future. So it's one of those things that you have to have a long-term vision on it or don't play it, just trade it, so to speak.
Mark, speaking of brand, out of those space, MGM, Penn, and DraftKings, 3 of your favorites in this space, which one of those has the best brand image? Because again, when you said that, it made me think of that start with why conversation all of us have had many times, and why Apple became that juggernaut company when Hewlett-Packard and Dell were doing the same thing, right? In fact, better quality, but Apple became that brand awareness that got into the social conscious to a certain extent. Which one of those 3 would you say has that ability to capture the attention of the consumer base a little bit more, just simply from a brand awareness?
I think DraftKings currently, obviously Portnoy, Penn National Gaming is all about Portnoy, but they are just getting into any aspect. Portnoy is we advertise for you, DraftKings, you pay us to advertise model right now, where they're trying to broach into the other. I also like, I like MGM a lot on the BetMGM, because I think there is some traditional brand name awareness. I still think MGM has the biggest brand name, and I trust the ability of MGM to have the infrastructure, lobbyist, people to get their app into different states. Now, I like to dabble in all of them a little bit, because, and I think in online betting, there isn't going to be one winner. I think there's going to be a lot of winners.
Yeah.
So, it's a space I like. It's a space I would like to get a little of long-term ownership on.
So
even if I have to pay a higher multiple than I like.
So would you agree? And again, I just wanted to get your take here, Mark. If you're looking for the safety play here, you would probably go MGM.
Yeah,
and if you're going to the growth play, massive appreciation type play with a little bit more risk, obviously, you'd be selecting one of the Penn versus DraftKings type space.
Yeah, I think so. And I've sold naked puts on all three. I have naked puts currently on 2 of the 3, and I like the MGM also, because, once again, I like to make my COVID return to normalcy bet. And so, MGM can, even if their bet MGM didn't work out as well, or it was just a little bit, eventually there's going to be a return to, COVID's not going to be with us forever. MGM is a long, big company with a long history of running casinos. So, there's a little bit of the safety play in MGM.
Well, you get the dividend, right? You get the dividend on MGM.
I think their dividend's a penny right now. So.
Oh, they cut it?
Yeah. So,
no. So, price.
But I like all 3. I like all 3.
Kind of weak.
The what?
Yeah. Oh, I'm just thinking from a valuation perspective. Yeah, I would agree, Mark. I think MGM's the play if you're looking at a little bit more conservative. You want to be a little bit more conservative, risk adverse. Maybe you're looking to do a little bit more from a cover call perspective, because I've never done a cover call on DraftKings or Penn, but I could assume it's a nightmare.
I bet it's a nightmare. Volatility
I can assume it's a nightmare.
We're at 10% today,
the only way you do covered calls on Penn or DraftKings with a long-term ownership is you look at real low deltas.
Deep out of the money calls.
Because let's say I own DraftKings right now at 39. Even up at the 50 strike price, I can get
the option chain. So a little context while we're talking about this.
Let's pull up those monthly options 24 days out. Even if I went clear up to $50, which is, 0.17 delta, I can get $75. I can even get 30 or $32, split in the middle, maybe even 33 on the 55s. If you are doing covered calls on some of these things and don't want to lose ownership. Now, if you don't care about losing ownership, if you're more of a position, and if I make some money and called out, those 45s at $1.60, great, which are, right above that resistance level, so you might be able to do something. But you have to go low delta. That's kind of this environment in 2020 as well.
And Mark, the DraftKings, even at that 50 strike price with a delta of 18, you're still bringing in what, $75 in cash flow? Which is about, what would that be, about
almost 2%.
Almost 2%, which is pretty good for a cover call at like a 30 to a 35 delta. But if you guys will look at the volume and the open interest there, you got 6,000 open interest on that 50 strike price. You have 3,500 in terms of volume on that strike price. And so that deep out of the money, sometimes you don't get the liquidity, but you're still getting massive liquidity there. You can get in and out of those calls in lightning quick speed. I still think it would be a nightmare. You got, you're 20, you're 20% out of the money there with an 18 delta. You're probably not getting called out, and that's the way you probably need to do it, is to go deep out of the money with DraftKings. I still think just getting MGM from a cash flow perspective, probably the right way to go. If you're looking at growth, you're picking DraftKings or Penn. If you're looking for the safety play, covered calls, I think you're looking at MGM.
Yeah, no, MGM just has that little bit of get some space. I mean, if you picture the future and online betting becomes huge, right? And the thesis is correct. MGM has a lot of upside just on that. And you get this little, hey, I get to play a distressed industry still off. I mean, what is MGM off its highs from pre-COVID? You know, a good 30% still. So you get to have kind of your cake and eat it too in both. Like play a little bit of stress, play the space. Yeah, I mean, volatility's come down, but you can still get reasonable prices for naked puts. You know, volatile and uncovered calls and such. So, some food for thought in the area.
You know, it's a really, really good point for cover call traders and understanding what delta, what volatility to play. If you're going to play certain kinds of companies, you got to know the personality. There's no doubt about it. And by the way, Tackle 25, wonderful course on how to trade cover calls, some of the concepts about strike price selection, things like that. If you're new to the cover call game, I would definitely start with education and that Tackle 25 course. Interesting questions out of Technidium here in the chat. Just real quick one, INDA, if you can. Noah, Technidium, the Indian stock markets can be very similar to most emerging markets. The best advice I can give you in the short term is learn how to read a chart, because so much action and information is priced into the ETF. This is an Indian stock market ETF chart right here.
Yeah, the Nifty 50 brings back memories for me, no doubt about that, and not necessarily good memories. I was in Mumbai, India a few years back teaching, and I had probably 150 people there, and all they wanted me to do was tell them what Nifty 50 stock to buy. Mm-hmm. And like when I was trying to get them to even embrace opening up an international account to trade into the U.S. markets, they did not understand the power of it. People in the U.S. don't understand how good we actually have it, right? Context, Tim, you always say this, context matters. The liquidity of the U.S. options market is so much better than any market around the world. Every other market around the world tries to get to our open outcry market maker, guaranteed bid-ask spread, all that stuff, and they just don't have the liquidity to be able to do it. You can't do what we do on the Nifty 50. It's impossible. You can't do it. There's just not the volume in the options market, and not all of them trade options. The options market is still in its infancy in India. And it's honestly not that difficult to open up a US based brokerage account, fund that US based brokerage account, and trade US markets. But it was very difficult to get them to comprehend that power, because honestly, they thought I was telling them to give money to the US. And I'm like, that's not how it works. But, it's just the power. Again, it just made me so grateful that, we live in an amazing country that has an amazing financial situation. Yeah, we're going through some difficult times right now, but overall, it's truly is beautiful to be able to be born and raised in an environment that we can do what we do, and other countries just simply can't do it. There are so many economic benefits we have that the rest of the world does not enjoy. And if you've traveled internationally, you know exactly what I'm talking about. And it does give you a different perspective on the quality way of life that we do enjoy in the U.S.
Well, yeah, absolutely, 100%. In terms of the options market here in the U.S., Matt, I think any international investor who truly wants to trade options, you got to learn how to open an international account. I do feel for Technidium here, and welcome. I know I've seen you in the channel many times, Technidium, so welcome back. Great to have you. Come and get financial education here from Tackle Trading.
Yes, Swin, I agree with that. Options are a new concept for most Americans, and when you teach Americans, yeah, it's a difficult concept to comprehend. There's no doubt about that. But it's like literally it's a new concept for Americans, but it is a non-existent philosophy for a lot of people internationally. And so when you introduce this topic internationally, it's just like I've taught enough Americans to realize the deer in the headlight look. But when I was internationally teaching this, like in Hong Kong, I didn't get that at all in Hong Kong. Like it was they really embrace international markets. They really embraced money being in Europe or money being in America or whatnot. Even in the Philippines, obviously there's a lot of history between the Philippines and the US. They embraced it. But when I was in Taiwan, they embraced it. But there was a lot of expats that I taught when I was over there in Taiwan, the same way you did in Malaysia and Singapore, Tim. But India was a different beast. There was a lot of concern about shifting money outside of India, and I'm not that familiar with the culture, but they just wanted more. Tell me what to buy in India.
Mm-hmm. 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 Yeah, and obviously, I mean, that's not going to give you the old teach a man to fish instead of give him a fish. Obviously, is a good analogy.
Well,
here.
even though, like, I would literally bring up Nifty 50 stocks and teach them the technicals behind that, but it just there was some mindset hurdles to overcome there.
Mm-hmm.
Oh,
Mm-hmm.
Swin, I agree with that so much. We should absolutely stop complaining and stop acting like this is the most, divisive place we've ever known. No, let's have some perspective.
Some perspective. I feel for my man Technidium here. He says, here's the situation not good. Nifty 50 keeps going up without any meaningful correction.
Technidium, there's a lot of people in the US saying that same thing.
That's the whole world right now, brother.
That's the whole world.
Dude, everybody's waiting for a dip that isn't materializing, right?
The stock market is not the economy.
Hey, it is 1:50 Eastern, and we haven't looked at Bitcoin yet. This is a travesty. I'm not happy with this.
Let's flash through the energy and commodities as well. Crude oil, Bitcoin, we can take a peek at. It is pulling back here, Mark.
Yeah, no, that's a break of the 20. We were talking about this yesterday, and Matt was talking about from a technical standpoint, it was a ugly looking chart, and that's how it's playing out today.
Yeah, I don't care. I don't trade it as a swing trade. For me personally, I have a completely different mindset with Bitcoin. But again, I have fundamental conviction, Mark. I mean, this is an idea. Bitcoin could drop to 7,000 below every moving average on that chart, and I wouldn't change my opinion, because I don't really trade Bitcoin for me personally, but I get it. Technically,
fundamental conviction is an amazing thing, isn't it?
It is.
Yeah, you can discount anything negative towards it.
Don't care. That's right. Don't care. Crude oil first. Let's take a peek at a couple of charts here. Nice little green candle.
My philosophy against the central bank, I should embrace Bitcoin far more.
You absolutely should. I think you're coming around, by the way. I'm hearing I'm hearing
dude, there's room on the party bus.
I come around, and then I listen to idiots on social media, and I'm like,
get off Twitter.
God, I can't be a part of that crowd.
Yeah, don't let Twitter grab you. Maddie,
are you kidding? I read some of the things. Dave Portnoy, who was just testing the waters in crypto, and
no, he's not, is he?
I'm not the biggest fan, but he got out of crypto and said he's moving back to the stock market, and he lost like 25,000 trading some altcoins there. And Tim, I read through I did something that people should not do.
Read the comments.
I started reading the comments, and as I was reading the comments, I'm like, I'm sorry, and I'm not trying to be offensive, but that is not a crowd I want to be a part of.
Yeah. But they're probably the radicals in the comments.
I mostly in social media.
Absolutely.
Absolutely. It gives you a bad perspective. I absolutely agree with that.
I mean, you're not sitting down with engineers who understand the code and the back end and all that kind of stuff, who are sensibly explaining what they like about certain cryptos and coins. You're in the Dave Portnoy comment thread.
I know. I get it. I know. It's a great point. It's a great point. You're absolutely right. It's a great point.
Yeah.
No, you listen, the Dave Portnoy, having visited there for entertainment several times, you want to short everything when you're reading the Dave Portnoy comments.
Well, and Mark, I've told you this, mate. Like, I don't read comment threads, like ever. Like, I don't. That was like I dove into it just to kind of see.
Dude, it's a trap.
And 10 minutes later, I'm like, oh my God, I am emotionally triggered.
No, there is a lifestyle adjust, and I'm a huge comment thread reader because I like to get a feel for what the investing. So I read all kinds of threads, but there is a lifestyle adjustment, because a rational human being, when they start reading the threads, is like, the whole world has gone batshit crazy. I want to short everything because these people are idiots. And then you get adjusted and numb to it, and you're like, oh,
it was, Mark. Absolutely.
It's a real thing.
Response I had, because again, I'm not used to reading comments because I just don't want to see that. But I did. I dove into it, and 10 minutes later, I had to crawl myself back out of it because it was just like, oh my God, I just got in the mud. I didn't even make a comment. I just felt filthy and dirty inside because I felt like I needed to go shower.
Mm-hmm. Yeah.
10 minutes of comment thread, I felt like I needed to take a cold shower.
Oh, I'm trying to think I've never read the Portnoy comment threads, so I'm going to have to compare it to something. I mean, would it be as bad as like a zero hedge comment thread?
Oh, no.
Oh,
It's totally different.
Different kind of animal.
The zero hedge tinfoil hatters, I actually, I got some of that in me. So.
Zero hedge comment threads will increase the amount of guns, bullets, canned goods that you own.
Yeah,
so,
it just increases your national preparedness is what it does.
Probably a good thing then. All right, let's flash through a couple things here. I do want to get to a couple stocks as well. Crude oil. Noah, give me a technical read on that chart. You're on mute. I just want to give you a heads up on that.
It's going sideways, Tim. Look at this thing chop. It actually is breaking above that 200 period moving average and showing a little bit of life today.
A little life
but
today.
that sideways drift just kind of made me wonder which way it was going to go. I kind of expected neutrality, but today's candlestick maybe gives me the idea that a breakout's possible here. There's a bit of an ascending angle to that sideways chop. And if you look at it in context, I mean, it's more than filled the gap it had from back in March. And, from 40 to 45, you got pretty clean air up to 50. So it'd be interesting to watch which way that goes, but I don't really have, an expectation for increased demand per se. But, if things open up, you might see a run.
Yeah. I mean, if I threw this to Matt, he would have just said, don't care. Same chart for the last 2 months. Matty, I will not throw it to you today. Gold.
Let me say it anyways.
Well, I was going to say meh, but I figured I should actually try to give some commentary there.
You've been gone from the halftime report for a good, 10 days from the halftime report? You've been on vacation.
Thereabouts, yeah.
Days. So yeah, it was good to hear somebody actually say something that made some sense on oil, because for the last 10 days, my analysis had been literally, I could care less.
Well, really nothing's changed that much. So
listen, I hope it breaks, and I hope it runs, and I hope it sets a new price threshold, higher high right there about 45, and it gives us a nice little retracement back down to retest the breakout channel. At that point, I'll wake up.
I don't care what it does, go up, go down. The volatility has died. I just need
you need some pickup so you can cash flow, Mark. I'm guessing.
Yeah, I need give me some give me some volatility on oil.
Yeah.
Greedy cash flow player, not enjoying 2% ROI.
I agree. I agree.
No, God, so 2020 spoiled cash flow people. Are you kidding?
Yeah, it's like always give me volatility when it goes up. 2020 has been disastrous for long-term cash flow traders, because they're like, okay, I get the volatility that I typically only get when markets go down, but now markets are going up and I still get that volatility. New age, I can get double the cash flow and the price goes up and I never have to worry about going down. Oh, you cash flow experts are so spoiled.
Are you kidding? DraftKings volatility skyrocketed today on its huge move up. No. So we're getting volatility bumps on the way up, on the way down. I'm going to there is a reason I say this is my favorite market of all time. I am going to miss it when it's gone.
Well, there'll be a new market. There's always a stock that's got volatility.
Yeah, if it's like this oil market, I'd be like, yeah.
Yeah,
I get it. There's always markets, but I do agree with Mark that cash flow traders have been extremely spoiled with bull puts, naked puts, credit trades, especially on the bullish side, because markets have just kind of went up and up and up, but they went up so fast that the volatility has actually increased. You're getting a higher cash flow rate with a higher probability factor, and you better not get used to it. That will change.
Cash flow in 2009 was pretty good too. I mean, after those crashes on those upward moving markets that recover, you usually keep volatility a little bit higher, get the premiums. I agree. I don't disagree with it.
No, they do happen. It's just very rare that they happen on the upside.
Yeah. There's nothing in gold grabbing my attention. We're going to flash through that one, then move on. Same chart, same analysis as yesterday. Go back and watch yesterday's show if you need it. But basically, we like the consolidation. Let's talk companies here, Matt. A couple companies had earnings today I want to get to. I also want to talk Apple and the Fortnite news, and American Airlines and Delta Airlines cutting some jobs. Let's start with Apple in the news.
Let's start with Apple. Yeah. Apple in the news for many reasons here today. Not only the reduction on the Dow and all that jazz, but the Apple is in an epic legal battle. Did that work? Apple's in an epic legal battle.
That did work. Actually.
Did that work?
Yeah.
That worked. Okay, good. So Apple is in obviously a battle with Epic Games, and the judge, we talked about this a couple of days ago, the judge that is hearing the case is the same judge that dismissed a very similar lawsuit a few years ago regarding Apple and their antitrust violations and the monopoly arguments that people make against Apple. So if you remember yesterday, we talked about how Microsoft jumped into the fray here and I don't exactly remember what they filed, but they filed a motion to basically to support Epic Games and specifically the Unreal Engine, which Microsoft leases from Epic Games. And not only Microsoft, but a lot of other companies lease from Epic Games as well. So the judge ruled today that between the Epic Apple fight, that they ruled that Apple does not need to allow Fortnite, which is what the primary lawsuit is about. Now, remember, Fortnite basically changed an in-game purchasing structure that was in violation of Apple's 30% rule. And so Apple removed Fortnite from the App Store. Epic filed a legal challenge against that. The judge rules that Apple does not need to allow Fortnite back into the App Store, that it does not violate antitrust because they were basically, violating Apple's policy. And so the Apple does not need to bring Fortnite back to the App Store, but, and this is the kicker, but they're not allowed, Apple is not allowed to block the development and distribution of the Unreal Engine that Microsoft supports. So par for the course, 2020, we support Apple, we support Microsoft, everybody else, whatever. But Microsoft gets what they want, Apple gets what they want. But that's just today. This is going to be a very long legal battle. A very long legal battle, and this is just one of the forks in the road that we're going to cross in discussing this. Now, the importance of this is because what it signifies to Apple, their revenue, their policies regarding everything people have been talking about with antitrust violations. And so obviously this is going to be a very, very important case to be tracking. Maybe not to the same degree of tracking the contractor versus employment status that we're tracking with Uber and Lyft and the state of California, but it's a very important legal fight between the Apples and the Googles of the world and against Epic. So it's something that we're going to be tracking over time. But as of right now, a slight win for Apple, a slight win for Epic. We'll see how it plays out over time.
It's also a slight win for Microsoft, right? I mean, getting the ability to use that platform for.
Well, yes, it is. The Unreal Engine is licensed not just by Microsoft, but many, many other tech companies as well. And so when Microsoft joined Epic in a battle against Apple yesterday, you basically, I mean, that is the gorilla jumping into the fight here. And so Microsoft joins, the judge rules in on behalf of basically Microsoft and Apple, and we'll see what happens to Fortnite over time.
Next here, actually, let's take a look at American Airlines or Delta Airlines. More continued pressure and storylines around this
People
industry.
lose their jobs, markets go up.
Yeah. Americans cut 19,000 jobs. That's across all different parts of their business model. Delta, though, is cutting 2,000 pilot jobs here, Matt. I thought part of the stimulus earlier in the year in the CARES Act was that these guys can't cut jobs. Is that deadline come and gone? Are they circumventing it? What is the deal?
Listen, that was 3 months ago, Tim, right? Let's bail out the airlines to the tune of $55 billion when they've spent $50 billion in stock buybacks. And let's ensure that the people that work for these airlines are getting gift wrapped in money from consumers. Let's just keep their jobs for 3 months. But now, you know what? Let the corporations fire anybody they want. This is one of the concerns we had months ago with the CARES Act about the moratorium that was put on the elimination of jobs that companies, businesses were getting in those loans. And now we're starting to see companies be like, okay, now we're past the date. We're going to start laying people off. You could probably start to see foreclosures rise here as well.
Yeah. Yeah, it's disconcerting news, obviously, but yet that chart keeps looking like it might want to break and run here. I'm not interested at all in these airlines, quite frankly, down here. If I want to
I
place
have
something
zero
distressed,
interest in the airlines. I don't have interest in the companies that literally all they do is buy back their own stock and get gift wrapped bailouts from American taxation. No, I have no interest in participating in that. Swin, I have both Apple and Microsoft. Do I have to pick a favorite? I mean, that's like picking your favorite. Who's your favorite child, right? And I don't know if I want to admit that. I love them both. That's 1A and 1B for me. So if they were correlated 100%, I would say pick one. I don't think you have to pick one. I am supporting Epic Games. That I am supporting Epic Games because I don't think it's good policy moving on into the future to have Google and Apple be able to dictate terms to all these other smaller companies that have to use their services. So no, secret choice. Like there's nothing secret. I can't be secret. I'm public. So I would say if I had to pick one, I am supporting Epic Games in the legal fight. But if I had to pick one or the other investment, I'd pick Apple. But I do support Microsoft in their legal challenge with Epic Games.
Yeah. You can't pull favorites with your kids.
Not want to fight Apple. Like
no,
you don't want.
By the way, that Microsoft breakout is looking pretty if it does develop. It was on the option report over the weekend. If you're a pro member, make sure you review all of those picks on a report. That's sexy up there, guys. Let's just call it like it is. If you can catch a breakout of that resistance, in fact, Noah, this would be a great one for the coaches show tonight. Talk about targeting.
Beautiful potential breakout. JT, I would say in terms of your question, I would say the move in the bond market over the last week has really indicated that they don't believe in the stock market movement as much as what we've seen in the stock market. So I think the bond market is suggesting that the move in the stock market has been unrealistic in the short term.
Patricia has a good question. I want to throw this one to Marky. Long-term member of our community, wonderful member of Team Tackle. Nice to see your name as always, Patricia. I never bought stock after it split. Since it's happening on Monday for both Tesla and Apple, do you buy it that day or wait a couple of days to let the price settle in?
That is such a difficult conversation to have in 2020.
Listen, I think you treat it post earnings, right? I think you treat, and when I say that, usually I like to wait 3 days for some sort of intraday support resistance levels to form and then base it off technicals of that. And so that would be my advice, is that, because everything we do, always, we want to have a logical reason why we do it. If we're going to invest in something, we want to have fundamental conviction and a great investing thesis. If we're trading, we want to have clear signals. And so I think, with Apple, with Tesla, waiting for 3 days, waiting for some sort of intraday support resistance levels to form, kind of like you have after a gap on earnings or something like that. I think that's the advice I would have.
It's really hard for me. I mean, typically before 2020, my answer would be different. I would say wait a few days before 2020, because there's a lot of evidence in the past that there's a bump up and then, a little bit of profit taking post, the buy the news, buy the rumor, sell the news type of philosophy. Man, the movements we've seen in Tesla and Apple post announcement have been historically unprecedented. It's not shocked to see a bump, but it's fairly unprecedented to see the price movements in Tesla and in Apple that we've seen. And I actually read one report today, guys, that there are people at Robinhood that truly do believe that if you buy Apple, if you buy Apple before the split, you basically get 3 additional shares for free. Like I'm dead serious. Like,
oh no.
And yeah, I know.
Yeah, this all ends well, right?
How does that work? Explain to me the logic.
Well, they signed up for the app, they got a free share, right? I mean, they're probably used to getting free shares.
It is. I'm serious. Like there are reports that Robinhood traders believe they're getting 3 free shares, and it's just like, oh God, help us all.
This ends really well, right? When it's all said and done.
And so we've seen the importance of Robinhood, guys, because it's the number 1 broker right now by activity in volume, and it's not close. It's not close. I mean, they're like twice as much as Thinkorswim right now, which is second. And so post split, could you see millions of people coming in being like, oh my goodness, I just don't know. I just don't know. And I hate it. I hate it. It drives me nuts.
Because of the
crazy,
unknown.
but I don't know.
I think the prudent advice is what Mark said, though, and you've said here.
I think you got to treat it like an IPO and see how the market performs.
Yeah, I think you got to wait. Let's move on. Let's talk a couple other quick ones here. Give me Facebook if you
historically can. On Apple, Ahmed, basically Apple split down to 79 and initially sold off, found a bottom and skyrocketed back up. Mm-hmm. And so that's the Apple historical example is kind of what is typical, that you do see a little bit of profit taking post split when it actually splits, and then you make that nice run up to pre-split type analysis. So I just think historically we don't know. I don't think we can use history as the judge here on Tesla or Apple post split. And I think you might miss out on an opportunity, but that's fine because you're not going to take the risk. Yeah. I think you got to wait to see how the market performs post split.
I agree with that 100%. We were talking yesterday that maybe Zuckerberg was, kind of playing his little, Tweety Bird impression there, giving the information to the administration that there might be problems with Chinese tech and privacy and all that kind of stuff. I think I might have figured out why, which is an obvious connect the dots here. I saw some data here today, Matt. TikTok has over 100 million daily active users in the US alone, bigger than Twitter, bigger than Pinterest, bigger than Snapchat, and right in par with Instagram. I found that number to be pretty impressive. Quite frankly, it didn't surprise me.
I said yesterday, Zuck's speaking his book, but it doesn't mean he's wrong.
No, he's not wrong, but he is talking his book there. Obviously, 100 million daily active users, which I can only expect to go up as long as TikTok gets some deal done. We're talking Microsoft. We're talking all these companies right now. Just a reminder, that TikTok thing is still out there and looming, and we got to figure out and get information as to when that thing gets clarified. Another one in tech, Matt, then I want to get earnings here. Baba, if you can. I don't know if you saw.
I wonder why Facebook hasn't been in those conversations with TikTok acquisition.
It would make sense. I mean, if you want to talk about business model, they're the ones who run these applications. That would make sense to me.
It would also target them from a government monopoly perspective, though, too.
Yeah. It sounds to me like Oracle is going to get the deal. Just my instinct, by the way. But it seems like the administration is very favorable with, what is this, Larry Ellison, right?
Larry Ellison.
Jack Ma's company Ant Group is going to be IPOing here. Obviously, it is not Baba Matt, but when that IPO does come out, it's $150 billion valuation. I thought that was going to be interesting. We'll see, when they get regulatory approval and down the road. I thought that was just an interesting company to keep an eye on. Jack Ma just been an incredible visionary entrepreneur for so long. He grew Baba to what it is. This Ant Group thing, I think it would be a very, very compelling company to keep track of. But really, Matt, last things I want to talk about here are those earnings reports on Best Buy and PanW. Let's take a look at the numbers here. BBY.
Yeah, let's take a look at BBY first and foremost. I said yesterday on BBY that, listen, and when we were talking about the upgrades, I said you needed to wait for earnings because they have done massive price appreciation. A lot of those earning numbers are baked in because they released them prematurely about 6 weeks ago. I felt like the upgrade was a mistake just simply because you have went up too fast and too short of a time period, and you have to show something at that point, right? You do. And this is why it's important to understand how earnings is impacted in relationship to markets going up versus markets going down over the course of that earnings season. Best Buy reported a very, very good earnings report, in my opinion, just from a numbers perspective. They came in at $1.71 a share versus the expectation of $1.09 a share. So a nice healthy beat on EPS numbers. They came in about 9% higher on revenue numbers as well, with Best Buy coming in at the 9.9 billion versus the 9 billion in expectation. Revenues and same-store sales also beat expectations as digital sales, guys. Digital sales, and we've seen this in strong online presence companies, they tripled in the last quarter, guys. Tripled in the last quarter. Now, like many retail stocks, though, in this quarter season, the CEO, Matt, I believe his name is Billius or something like that. Great first name, by the way, but he basically stated that to not expect this trend to continue the same way Target said it, Walmart said it, Costco said it, and other retail giants said it as well. And so I think that gave the market a little bit of, on Best Buy, a little bit of, oh wait, earnings numbers are really, really, really powerful, but they expect it to kind of come down in price. Now, the reality though is this, guys. This to me was one of those moments in time where you've had massive price appreciation, very similar to what I said on Microsoft. This feels to me like this was kind of one of those moments of, listen, we've had great price appreciation. We know Best Buy is going to do good because they've already told us they're going to do good. That expectation is built in. Let's profit take here. That's all I'm seeing here today in terms of the performance. A little bit of, hey, we've had a great quarter. Let's lock in some of that profit. Not a bad decision. Still a company you should be tracking. So don't take that negative price movement as an indicator of something bad in their earnings numbers. It wasn't. If this stock was neutral coming into this report, this stock would be up today. If this stock was down on these same numbers, this stock would be up today. This stock had great price appreciation over the last 6 weeks, and the numbers were fantastic. But again, you got to show me something after that type of price appreciation coming into earnings, coming into an earnings report. So I'm simply taking this as a good report, obvious profit taking. Let's reestablish support and let's see what we can get on it again.
Yeah. These the commentary coming out of these companies on their earnings reports, I mean, they've got to know that if they talk about the economy moving forward or give guidance or have any kind of caution, the market's not going to like it. I mean, one of the things they said, Matt, obviously is some disturbing stuff about, well, maybe if we don't get a stimulus or people don't get back to work or this and that. I mean, if they just shut their mouth, give the numbers and say we're pulling guidance, the stock would have been up 5% probably, because
these are A-type personality leaders in business, and you want them to shut their mouth? How does it? I'm sorry. Listen, I have that type of personality. If somebody tells me to shut my mouth, I promise you, I'm not talking for the next 48 straight hours.
Right.
And I promise you, I would say things that were probably not good for our company.
Yeah.
Because no, they're A-type personalities. They've had a lot of success in their life, and they want to speak to their investors.
And they did. They painted not a dire picture.
It
but
wasn't
they were just
dire.
Honest. They were just honest. I mean,
it wasn't dire.
Here's the quote.
Yeah,
overall, as we plan for the back half of the year, we continue to weigh many factors, including potential future government stimulus actions, the current shift in personal consumption expenditures from areas like travel and dining out, the possible depth and duration of the pandemic, and the risk of higher employment over time. Unemployment over time.
Listen,
so he's just,
if there's one thing to learn in the last 3 weeks of earnings reports, specifically in the retail sector, it's if you give consumers money, they spend the money, and look at the record types of beats we're seeing versus expectations. I mean, Best Buy does not routinely come in 60 cents above expectations on EPS numbers, guys. That is a blowout. They typically don't beat 9% on revenue expectations. That's a blowout. And the only guidance concern is, hey, are we going to not give consumers money? Right? I mean, you're seeing it at play right now. It's not the amount of money you do from a fiscal perspective. It's not the amount of money you do from a monetary perspective. It has absolutely nothing to do with the balance sheet or the level of money you put into the market. It's where that money goes that has the impact.
Mm-hmm. Another reminder, though, that this quarter, these retail shops that have online presences, they've been killing it. Last week we saw it. This week we see it with Best Buy starting out. What about PanW, Matt? Company that we particularly find interesting. I think it might just be us, by the way. It's just another one of these big names. But for this sector, this space, cybersecurity, it's kind of the first name I always think of personally. What did you see in the numbers?
It's me too, and I'm not even sure PanW is the biggest or the most fundamentally strong of the cybersecurity companies, but it's the one we always kind of just gravitate to for some reason. And again, I think it's just might be because we've traded it. Right, one day down the road or in the past, we found it on a great technical setup, and we're like, oh, let's just trade PanW.
Mm-hmm.
PanW's earnings report came in at $1.48 a share versus the expectation of $1.39. Decent slight beat on EPS numbers, also a slight beat on overall revenue numbers at 950 million versus the 920 million dollars on their expectation. Revenue numbers overall on a growth stock went up 17.9%. Not exactly great, robust numbers. I'm taking this earnings report on PanW as extremely lukewarm. I mean, if you could come in and say, okay, what's the most boring report you could give? You just tried to do it with PanW.
Mm-hmm. Mark, it's been a pretty good trending stock here for a bit. It was approaching, I think, new highs here. Do you have any interest in this company? Is this one you track, you trade, you find interesting?
I think PanW is a great stock to pick on really deep pullbacks. It's very volatile, has been for a long time. It's just the personality, right? It's got lifted up with everything in the big. It's a good company. It's a company that's certainly at discounted levels represents value. So, I mean, it's just so volatile. I mean, you go back and look at the last few years of PanW, you just see these big, huge swings. And so it's one of those stocks to, you know, Apple may never come down off its levels, right? Or at least much not, or Facebook, you know, if this things. PanW is a wild child. So kind of like
you guys a question regarding not so much PanW, but cybersecurity stocks in general.
Mm-hmm.
With the increasing, you know, participation in online environments, and I'm talking pre-pandemic, there was a lot of concern about cybersecurity in general, protecting data, protecting privacy, you know, protecting against hacks. I mean, my God, how many different hacks have we seen, from credit agencies to banks to credit cards to hotel chains? I mean, you name it. And so the bullish thesis on these cybersecurity stocks was, as we increasingly gravitate towards online, both in terms of the amount of time we spend online, but also financial transactions online, personal data online, cloud-based storages online, so on and so forth, that cybersecurity was going to be even more important in the future. I think that argument post-pandemic is even stronger. Post-pandemic, when you're talking about now, I mean, I truly do believe there will be complete industries shifting online. There will be jobs that stay online. Schools will do more online. I don't think this moment in time is just going to be unique to 2020. I do believe trends will shift coming out of 2020 as well. And I think the speed of us moving online will be even more in the future than it was in the last 10 years. Does that give you guys a little bit more confidence in this space moving forward into the next decade, even more so than we did in the previous decade?
Marky?
You know, when I analyze cybersecurity stocks, I think we all agree with the general thesis that cybersecurity necessities will only increase it. So it's like the space, we love the space, right? Like cybersecurity will be needed. It's a great space to be in. Man, the field is so competitive. It's so competitive that and it's one of the reasons that you get wild swings, right? In a stock like PanW. So, I mean, love the space. It's just finding value and opportunity in a very, very, very competitive field.
So I don't even know this, but is there a cybersecurity ETF?
I'm sure, yeah, there is.
There's got to be. I don't know what it is off the top of my head, but let's go through a couple cybersecurity companies, and just off the top of your head, just looking at them technically, which one do you like the most? Okay, so we've already looked at PanW. Let's take a look at FTNT.
Mm-hmm. Fortinet. Yep.
I always think Fortnite when I pull this stuff.
It's pretty close.
Okay. So
not
FTNT,
interested technically.
Okay. In fact, probably interested on the downside.
Sure.
Let's take a look at OKTA.
It's been a juggernaut at times. It's kind of slowing down now. Not interested.
Double
now.
top,
That's
lower
reversal.
high.
Yeah.
Could be kiss of death type formation here. Let's take a look at QLYS.
Nope.
Terrible technical pattern there on Qualis there. Let's take a look at CrowdStrike, CRWD.
No.
No. And and let's take a look at ZS.
Momentum change. It's strong. It's the strongest out of the ones you just showed me. Obviously, that last one, CrowdStrike, if you break out.
So basically, in just purely technical in the short term, you're looking at ZS or you're looking at PanW.
Mm-hmm.
And honestly, the others are setting up for bearish technical patterns.
Yeah. And back on PanW for a second here, Noah. I actually probably out of those two, I actually still like this one better. You know, gap down into the moving average, still got a trend to it. I know the earnings report was not strong, Matt, but if you could
let's take a look at NET for JT.
Cloud.
Yeah, that's very similar to the other ones. Just a lot of chop, a lot of sideways action. If you're looking at this space, I'm looking at PanW, or I'm looking at the last one. What was the symbol on the last one?
We were just looking
ZS.
at ZS. Yeah. Zscaler, I believe.
Yeah, Zscaler.
So there's a couple of good ones in there, and they have had good performance runs at times, and some of these are very tradable, optionable, things like that. I think I've probably traded Okta, PanW out of those ones the most.
PanW and Okta have been on. ZS has been on the bullish watch list.
Yeah, we've had them
the last few months.
Yep.
It's a very crowded space. There's no doubt about that. I'm not sure there is a clear leader here in that space, but just from a purely technical perspective, I would be looking at ZS or PanW right now. From a fundamental perspective, I think most of this space is pretty overvalued right now.
Yeah, I'd agree with that. Let's start wrapping this one up here today, boys. Very much enjoyed the conversation. I mean, you know, it's always fun to come into the halftime report. We had good chat here today from Team Tackle out there. And Noah, it's great to have you back. You did not tell us the story how you wrecked your jet ski, though. Somebody said, I don't think it was you on that jet ski, but somebody was asking about that.
It was not me. It was my niece and my nephew. They ran over the rope and they decided to try to turn it over and try to get it on the rope out of the impeller. And it sunk halfway. So,
oh, no.
So had they just left it alone, not a big deal, nominal repair, but who knows what this is going to cost. Moral of the story is buy the extra insurance. I just assumed my credit card company would have my back, and they did not.
Yeah. So did your niece and nephew, they were fine though? They're not physically hurt?
Oh yeah. Everybody's okay. They were traumatized. They were terrified because they were out of sight, and you know, Lake Powell's a pretty dangerous place. So, you know, we're just glad everybody was safe. And then to top it all off, on the way out, my sister bottomed out our new ski boat, and we're looking at who knows what the repair bill on that's going to be. So it was Lake Powell. If you've ever been there, it's totally worth the trip, but be careful.
If you love boating, it's one of the most pristine places in the world to go and boat. There's no question about it. Southern Utah, Lake Powell, miles and miles and miles of coastline there in the center of the country. So people who love it, they do love it, but don't wreck your boat and come back with a bunch of bills is what I'm hearing here, Noah, from a life lesson. Let's start getting final thoughts here if we can here. Marky, you first for our team out there. What's on your mind?
You know, the Benjamin Graham quote that I put in the Bear Porn newsletter at the very end of it has been just on my mind all week. In the short term, price is the only thing that matters. It's why we say, look at the chart, you know, trust your eyes. That's what we do for trading. But in the long term, fundamentals are the only thing that matters. There's a huge detachment. Trade accordingly and invest accordingly.
Yeah, and I enjoyed the conversation we had on that newsletter in the podcast yesterday. Noah, tradingjustice.com if you can here while we're just wrapping up. If you're podcast listener, make sure that you go and grab that episode. We did just release it last night. We love our podcast, enjoy the conversations. And, you know, Matt, it was all about Mark's newsletter yesterday. Just a fun podcast for me to sit and talk to Mark about and all that kind of stuff. Matty, get your final thoughts here, sir. What's on your mind?
Honestly, I'm thinking about watching the Republican National Convention tonight, and I'm getting prepared mentally to listen to Jay Powell destroy the middle class this weekend.
Yeah. It's one of those deals. I mean, you know what he's going to say. You're still going to go watch it.
Listen, Democrats and Republicans unite in our disgust of modern monetary theory and the impact of inflation, average inflation on the middle class. That is a message we can all get behind. Unification, all political parties, disgusted with the top of the market and corporate socialism. That is a policy we can all get behind. Stop corporate socialism. Stop it. End it. It is the destruction of the American way of life in the middle class. Just let's fight. It's kind of like gold and Bitcoin, Tim. Different instrument, same team. We're on the same team.
And it really is sad, man. I didn't want to comment, but it does depress me too, Matt. And most Americans, because of how ignorant we are as a society, will not even realize what's happening to them. And inflationary.
Not until it's too late.
Inflation.
How many times in history, Mark, have we had to deal with politicians taking advantage of short-term situations that have disastrous long-term consequences?
A decade of reckless debt accumulation, a decade plus of corporate welfare. And well, we got to change inflation to try to mitigate those bad disasters. And guess who's going to pay for it? People that don't even know it's impacting them. Middle America's wealth, their ability, their purchasing power, going to be eroded, and who's going to benefit? And it's just, hey, listen, it's just sickening.
Okay,
and
in an environment in the last 4 years where basically, you know, we've had stagnation in consumer wealth, but now they're targeting higher inflation, which impacts buying power. This, yeah. So Tim, what my final thoughts? I am mentally getting prepared to listen to Jay Powell literally declare war on the middle class of America.
Well, I'm expecting several phone calls and quite a few fun conversations around that. And we will talk about it on the halftime show after the report. I got to look it up. I think I read somewhere it's Thursday night, actually. But I might be wrong about that. I have to look at the schedule as to when Jay Powell does deliver that speech. Whenever we do, we will break it down here.
He's going to say he's the man of the people, and I'm going to literally lose my mind.
I mean, he's just trying to help people, Matt. You know, get Janet Yellen up there too, talking about the need for Congress to
you gotta love the elitists talking about how they want to help the consumers when they built their elitist mentality on the backs and blood and sweat and tears of the middle class of America. Yes, thank you for representing us, the elite people of America. Appreciate that.
Yeah.
Like, listen, I don't want to go all populist and everything, but like, this is the kind of stuff that sends me to a radical place, right? Like,
yeah, like Mark, I can't read your bear porn newsletter because it just triggers me. I'm like, yeah, he's right on every point.
The only advice I'd give you on it, read it when the markets are closed.
Just read it in Mark's voice. Just read it in Mark's voice. It makes everything better. I
did enjoy that quite a bit. My final thought is very, very simple, guys. We appreciate you out there at Team Tackle. If
Team Tackle's the best.
You enjoy the show, you enjoy what we're doing here, give me a quick thumbs up there in the YouTube channel. It just helps our analytics. Very bluntly, that's how YouTube gets the word out about Tackle Trading's channel here, so other people can come and see what we're doing here. We're going to keep it real all the time. We're going to come each and every day, break down the news for you guys, and tell you what we're seeing out there in the marketplace. And hopefully our comment thread never gets like the Dave Portnoy comments thread there, Matt. We have a very highly intelligent, highly educated audience here.
Yeah. Right? Listen, I trust Team Tackle. Like,
I trust Team Tackle. Like, I just don't trust the internet.
No, I don't trust the internet, but I do trust Team Tackle.
Yeah.
The reality is every one of us at Tackle, we have our different belief systems. Like every single one of us do, but we're all very respectful of each and every person, because we believe we're all trying to fight the same battle. Different instruments, same battle, come together. Right. So no, I love Team Tackle. I trust Team Tackle. I love the fact that we have a very diverse audience, and yeah, I love them. They're like literally, every day I'm so eternally grateful for Team Tackle. I think these are some of the most amazing people out there.
Speaking of gratitude, I got to tell you a cute little scene I saw here when I went and got coffee before the show. You know, our little homeschool thing here, guys. My wife was teaching our daughters meditation practices here today. So they were sitting down, working on their breathing.
Good. Cat needs meditation.
Finding their center. You know, I think it's I thought it was a wonderful thing to teach. You know,
I was talking to your wife last night, and I said, Bree, when can we set up like once every Friday or something like that, where we're actually going to do 2-hour financial segments with our children. And so Tim or I is going to be teaching 2-hour segments to our 11-year-old daughters every single week on investing, stock markets, stop losses, technical analysis, fundamental analysis. Man, we're taking this online environment. We're going to create a bunch of juggernauts out of our daughters.
Absolutely, 100%. I also want to do a little segment teaching them on debate and logic, like have them practice critical thinking, all kinds of stuff. Yeah, absolutely. We're gonna have fun with this one. There's no question about it.
I am so excited, and I've thought about how I'm going to introduce these topics to our 11-year-old daughters.
Yeah.
And I'm going to do it this exact same way I introduce these topics to adults, because I teach adults the same way I would teach kids.
I love Dina's question here. Can you do a Trading Justice podcast for kids that we can play for the kids in our lives?
You know what, Dina? I think that is a wonderful thing. And I guarantee I have dual purposes with what we're doing with our kids. And so, yes, I think, we lack financial education within generations coming up, no doubt about that. And I would be like, I don't want to put the cart before the horse, Dina, but I do have plans on taking some of the content that Tim and I kind of use our children as a little bit of a case study, right? To see how to teach children these types of philosophies. But I'm willing to bet that we'll have something for Team Tackle to be able to share with your guys' kids, because I'm sure you guys are the exact same as me and Tim. We want the best for our kids, and we want them to have a financial, understanding of the way, the financial world really does behave. And I think the concern for a lot of us parents is we just simply don't teach that in our public school systems. And I think if there's one thing that we've all realized in the last 6 months is that teachers in general are undervalued, and teaching kids is not exactly easy. And so over the next month or two, I'm sure that Tim and I are going to have many conversations on exactly how to introduce these topics to, because our daughters are 11 and what's Maddie, 8? Tim?
11. She'll be 9 here.
She'll be 9. Yeah. So 8. I was right on 8 then.
You are right.
Okay, I was right on 8. Yeah. So my daughter's 11. Tim's daughter's 11, and Tim has an 8-year-old. And so we're going to be using them as a little bit of guinea pigs to introduce these topics. And then I'm certain we'll do a podcast on it, Dina. And we'll make sure to keep that one extremely, not even PG rated. We'll keep that one, like we won't even invite Mark, so it eliminates the risk of it going craziness.
For the podcast.
This is Max Loss, bedtime story for your children. So
I can see that. By the way, I would love Mark to come and teach the girls on history.
Not going to happen. I'm not going to have it. No, because all of a sudden Max Loss, and all of a sudden we have like 14 different personalities and whatnot. No, but I guarantee you guys, we're going to have a podcast on this experiment, because I think it's going to be cool. And we'll probably do some things for our pro member community, and we'll probably do some type of basic on demand down the road a little bit, where we basically would do a 2-hour type on demand based on teaching children how to do it, and not how to trade, but just some of the basic fundamental principles in economics and finance and whatnot. And like my whole goal is my 11-year-old to create an absolute juggernaut, just economic, just destroyer of worlds, in a good way, mind you, in a good way. I think she does have the personality. My oldest daughter, not my oldest, but my second older daughter, Moo, Brindley, she's got that silent assassin in her. Like she really does. My daughter, Katera, she's more of the, I'm going to throw grenades. So if I had to compare them to famous investors, I'd put my daughter Kat in the George Soros arena, and I would put my daughter Moo in the Warren Buffett arena. Mm-hmm. And you guys can take that to figure out what personality. Yeah, you can take that wherever you want to take that.
It's going to be fun. We'll keep, I'll just keep talking about it, quite frankly, because as a dad, I think it's really cool just to watch what's happening here. And I am looking forward to a podcast, a series, whatever it is we do around education and families and kids and young people. I think it's much, much needed in society. So we'll keep the team updated on that. We've got meetings, guys. We've got markets. We've got to go here today. Let's wrap it up for the day. We will be back tomorrow. If you're not yet a pro member, still same simple.
I'm very proud of us, by the way, today, Tim. I'm very proud of us. We did not take the bait and talk about phase one trade deal. I'm very proud. I'm very proud of that.
Soybeans. Okay.
So proud. Soybeans. Good.
Soybeans.
Thanks.
Yeah. Let's
Very
end
proud.
on that. Sign up for the pro trial if you're not on tackle trading yet, and we'll see you on site. Noah, good luck with the show tonight, and we'll be back tomorrow with the halftime report, same time, same station.